So here's the truth when you're starting a new business that you really need to start knowing. The IRS isn't trying to screw you with all of its tax laws. In fact, it's quite the opposite. The IRS is actually begging you to start saving money on taxes. But most new LLC owners, they don't know this. They leave thousands on the table in profit. Not because they're lazy, not because they don't care, but because they just don't know the rules of the game that they're playing. You're dropping money on your business in ads, marketing, gear, and other things to make your business run, yet you're scared to take them as write-offs because you're scared of, what if I get audited by the IRS? So instead of taking the deductions that you should be taking, you play it safe. I've seen this far too many times. Business owners, they finally start their business, they finally start to get traction, and then they get hit with this fat tax bill and they break down. They stop being able to work because they're worried about having to pay too much tax. Why? Well, that's because of what I'm about to show you right now. Look, I'm not just some random guy throwing tax tips out on YouTube. I've trained under top tax strategists like Mark J. Kohler, and I've taken several businesses from tax nightmares to tax saving machines and ultimately growing the wealth of the business owners. What I'm about to give you is straight from the IRS rulebook. No theories and no fluff, just straight to the business of what you need to do as a business owner. So the first write-off or a tax deduction that I see too many business owners missing when they first start up their own LLC and start running their business is startup costs. So before you even start your business, yes, before you start your business, you can start tracking expenses up to $5,000 in that first year that are able to be deducted in year one. So you can think of research, ads, consulting fees, stuff like that that helps you get your business off the ground. So if you spend, say, $8,000 on things to launch your business and get it going, you're able to deduct the first $5,000 straight away in year one, while the rest is amortized over a 15-year lifespan. So what you need to do is you need to track every dollar that you spend, whether it be on a basic Excel sheet or what I would recommend is on QuickBooks Online. It's the easiest way to do it. And you need to track that and keep a tally of it for your year-end tax preparation. Now, one key note about this is that if you do, in fact, track your expenses, you can't just say that you created a business without actually pursuing income or making a sale. It's crucial that you actually make sales within that year. It's just that you can start tracking the expenses before that first sale leading up to your first customer. So write-off number 2 that I often see missed is organizational costs. This is another foundational piece of your business as you're getting going, but it's separate from the startup cost because you get another $5,000 for forming your LLC, whether it be state filing fees or lawyer fees to get that LLC properly formed. Whatever entity you choose will have costs with it, and you're able to use those as business expenses. So if you combine these two, that's $10,000 in year one that you're able to deduct. And once again, this comes with a caveat that you're not just saying you're creating a business, but you're actually putting in the work to generate sales and revenue for yourself. So what I would recommend is you keep track of both of these, obviously, but you keep them in separate columns because you have $5,000 of startup cost and $5,000 of organizational cost that are both able to be deducted in year one. The third thing that you need to know as a new LLC business owner, or just any business owner needs to know, is that you're able to write off things if they are ordinary and necessary for you to conduct business. This is really the heart of tax deductions, as when you're doing business, you are able to write off anything that is deemed ordinary and necessary for you to run your business. So this opens up a whole can of worms of things that you're able to take as tax deductions. If it's ordinary and necessary in pursuit of income in your business, you can write it off. So think of things like travel, if you're going to see clients, cell phone that you use to call and make and write emails, business meals with clients or with your team, the internet bill, you name it. All of these go into the same bucket of ordinary and necessary expenses for somebody to run their business and are able to be taken as a business expense and ultimately a tax deduction off of your tax return. But there is a catch with this. It's the hobby loss rule. So if your business does not produce a profit for 3 out of the first 5 years that it's in business, then you are not allowed to take these deductions. This is because these business deductions are now a part of a hobby. If you're not producing profit, you're not churning out a profit year over year, then the IRS deems your side hustle or your primary business to be a hobby rather than a business. So for example, if you are a photographer that spent $15,000 in gear and travel for photo shoots, but you don't churn a profit soon enough, then you aren't able to deduct all of this, and it's just ruled as a hobby in the eyes of the IRS. So the lesson here is that you want to make sure that you track everything and that you churn out a profit. Because if you do this, you can significantly lower your tax bill. So this is the part that nobody teaches and people fail to learn. The tax code is not a punishment system. Rather, it is a code of incentives. It rewards people who take risk, create jobs, and stimulate the economy. If you're doing that, the IRS will reward you. All of these write-offs that I mentioned, they're not loopholes, they're instructions directly from the IRS. And if you learn the rules, you win. Simple as that. You save more money, and you can put that money into wealth-growing assets and multiply your wealth. So here's the 3 takeaways that you need to take from this video. Start tracking your expenses, learn what you are able to deduct that is reasonable and necessary for your business, and stop playing scared. The IRS gave you a map, and I showed you how to walk it. Now all that's up to do is for you to take action and implement it into your business. If you'd like more actionable tax strategies that you can take right now and implement tomorrow, then click the link down below and you can download my free tax playbook that'll give you 20 plus strategies for you to implement in your business today. So now you know the strategy, go take action. I hope you found the video helpful, and I'll see you in the next one.